For new investors, it can get a bit tedious always hearing about investing in the S&P 500. So you might be curious, what are the alternatives? Well, the stock market has something for everyone. Today, we will go over the different sectors of the market and understand when we should be buying them. It's your favorite investor, and this is the channel to help keep you invested and build your wealth. So the S&P 500 is made up of 11 different sectors. You have materials, consumer discretionary, consumer staples, financials, real estate, healthcare, utilities, communication services, energy, industrials, and of course, technology. I would say it's important to know how the market has been performing and which sectors of the market specifically have accounted for the growth. In 2023, the S&P 500 has had a tremendous year due to the fact that technology has performed so well to start the year. This is because of the likes like Apple, Microsoft, Amazon, Nvidia, Google, Meta, which are all a part of the S&P 500's top 10 holdings. The S&P 500 is up 17.84%. Meanwhile, ticker symbol XLK, or the technology sector, is up 38%. So what does this mean for us? Well, this means that we should be studying and evaluating the sectors that make up the S&P 500 to find buying opportunities. So let's go back to our previous example. We know that tech has been running since the start of the year. Going through our sectors, we can go to ticker symbol XLU, or the utility sector, and what do we see? We see that this has been down almost 10% this year. Why is that? Well, when sectors of the market move, specifically tech, money rotates from a safe value to plays such as utility, and it moves into another sector. You know what I mean? It leaves utilities and it goes into tech, or it leaves tech, goes into utilities. It doesn't always happen this way. But by diving a bit deeper, this market is literally screaming at me right now that utilities might be a good time to start buying and accumulating assets in this sector. Leaving your money in the other sectors of the market is great, but when things start to run, seasoned investors should begin looking for steals. So this is when new money starts to enter into other parts of the markets for that next run up or that next cycle. We can see the opposite being true. In December of 2021, we see that utilities began to run while technology was experiencing a drawdown. So what does this mean? As investors, we must understand that markets are cyclical. If you can come to the realization that you may be able to find deals in other areas of the markets, then you can put yourself in a position to see outsized gains. A simple dollar cost averaging strategy works, of course. That's probably one of the best ways for beginning investors, new investors, to get into the market and stay consistent. But for those with more time in their hands that like watching the markets, understanding this concept and connecting the dots can pay huge dividends in the future. You effectively are always buying on the low, or when markets are rotating between sectors. The key is consistency and remaining exposed to market conditions. No matter how you achieve that, that's the goal. So whether that's dollar cost averaging or paying attention to the sectors, you just want to make sure that you have market exposure. Anyways, if you made it this far in the video, I hope you got some value from it, and be sure to check out the bestdividendcalculator.com to start putting together your plan to build wealth. Link down in the description. As always, thank you for watching, and be sure to hit that like button and subscribe for more financial content. It's your favorite investor, and I'll catch you in the next one.